A business line of credit is basically a flexible pool of money your business can borrow when you need it, pay back, and then borrow again. Think of it as like a credit card, but usually with bigger limits, different fees, and sometimes better interest rates. Not always, but often. It's not a one-time loan where you get a lump sum and then pay it back on a strict schedule. It's more like having a financial safety valve. You don't have to use it, but it's there when things get tight or when opportunity pops up. A lot of business owners hear line of credit and think it's something fancy only big companies have. But small businesses use line of credits all the time, especially once they have a steady revenue and predictable expenses. It's one of the most common financing tools because business cash flow is rarely perfectly smooth. Even good businesses have months where money comes in late or cost hits earlier than expected. So what does that line of credit actually do? It helps with short-term needs. It's best for covering gaps, not funding long-term projects that take years to pay off. The classic example is cash flow timing. Maybe you pay vendors today, but customers pay you net 30 or net 60, or you're seasonal. Or maybe you need to buy inventory in bulk before a busy season. A line of credit can let you cover a short-term window without draining your bank account to zero. Then when the revenue comes in, you pay it back, and then the line of credit is available again. Here's how it works mechanically. A lender approves your business for a line of credit, like $25,000 or $100,000 or more, depending on your business size and credit profile. You can draw money from the line, often called a draw, when you need it up to the limit, but you only pay interest on what you actually use. If you have a $50,000 line and you only draw $10,000, you pay interest on the $10,000, not the full $50,000. As you repay, the available credit replenishes. That revolving nature is the whole point. Lines of credit can be secured or unsecured. A secured line means it's backed by collateral, like business assets, inventory, receivable, or something, even a lien on a property. Because the lender has something to fall back on, secured lines can sometimes have better rates or higher limits. Unsecured lines don't require specific collateral, but they usually require stronger credit and financials, and rates may be higher. Even unsecured business lines often come with personal guarantee, meaning you personally promise to repay the business if the business can't. That's very common for small businesses, so it's worth understanding. It's not necessarily a deal breaker, just know when you're signing. It's not necessarily a deal breaker, just know what you're signing. There are a few types of business lines of credit you'll hear about. Traditional bank lines are common. Banks tend to offer lower rates, but the approval process can be slower and the requirements stricter. Then there are online lenders and fintech lenders, which can be faster and easier to qualify for, but sometimes they have a higher rates or different fee structures. Some lines are revolving, you can reuse them, and some are not revolving or a draw period, then a repayment period, where you can draw during a certain time and then repay it down and the line may be renewed. Some are tied to receivables, invoice financing, where your borrowing power depends on outstanding invoices. That's useful for businesses that have big invoices with long payment terms. So when do you need a business line of credit? Usually when one of these things are true. Your business has uneven cash flow and you need a cushion. Or you have customers who pay late or on long terms and you need to cover expenses in the meantime. You need to buy inventory or materials before you get paid for the finished product. You're seasonal and want to survive slow months without panic. You want an emergency backup for unexpected expenses, equipment breaks, big client delay payments. You want to take advantage of opportunities like bulk discounts or a new contract that requires upfront cost. The key word is short term. If you need money for something like that, if you need money for something that takes years to pay back, like opening a new location, buying expensive equipment with long useful life or a big expansion, the term loan might be better than a line of credit. Using a line of credit for long-term debt can lead to situations where you're constantly carrying a balance and paying interest forever. It can still happen, and some of the businesses do it, but it's not ideal. Lines are best when you can draw, use it, pay it back relatively quickly. One of the biggest benefits of a line of credit is flexibility. With a term loan, you get the money once and you start paying on a schedule whether you need it or not. With a line of credit, you borrow only what you need when you need it. That can make it easier to manage costs and avoid borrowing more than necessary. It also makes a line useful just in case tool. You can open a line when businesses are doing well, and then you have it available when business gets rough. Because here's the reality. Getting approved for credit is easier when you don't desperately need it. When you're struggling, lenders get nervous, so many business owners try to get a line of credit while things are stable, not during a crisis. Now, there are costs and risks too. Lines of credit usually have variable interest rates, meaning the rate can change over time based on market conditions. Some have annual fees, draws, or maintenance fees. Some require you to maintain a certain account activity, like using the line periodically. Some lenders require periodic financial reporting, and many lines have covenants, which are rules like maintaining certain financial ratios or not taking too much additional debt. Small business lines are usually simpler than big corporate ones, but the terms still matter. Also, it's easy to misuse a line of credit. If you use it to cover ongoing losses, like your business isn't profitable and you're borrowing every month just to survive, that's a warning sign. The line might keep you afloat for short term, but it can also dig a deeper hole. A line of credit should ideally be used for timing gaps and growth opportunities, not to patch a business model that's bleeding. That doesn't mean you can't use it in a rough patch, but you want a plan to fix the underlying issue, not just borrow forever. How do you qualify for a business line of credit? Lenders usually look at your credit history, business revenue, time in business, cash flow, and sometimes your business bank statements and tax returns. Traditional banks often want at least 2 years in business and decent financials. Online lenders may approve newer businesses, but rates can be higher. They may also look at your average monthly deposits. If your business has steady inflows, it's easier to qualify. If revenue is inconsistent or declining, it's harder. If you're shopping for a line of credit, you want to look at a few things: the interest rate and whether it's variable, fees, repayment terms, draw rules, and whether there's a personal guarantee. Also ask how quickly you can access the funds after approval. Some lines let you transfer money to your bank instantly. Others take a day or two. If you're using it for emergencies, access speed matters. Also, pay attention to repayment structure. Some lines require interest-only payments monthly with principal due later. Some require a portion of principal each month. Some have a cleanup requirement, meaning you must bring the balance down to zero at least once per year. That's actually a good discipline tool, but it can surprise people if they didn't plan for it. A smart way is to use business line of credit is to treat it like a tool, not like income. Use it when you have a clear reason and a clear repayment plan. For example, we're drawing $15,000 to buy inventory for the busy season, and we'll repay it over 60 days as sales come in. That's a healthy use. A less healthy use is we're drawing down $15,000 because we're short every month and we hope it works out. Hope is not a repayment plan. In the end, a business line of credit is like financial shock absorber. It helps you smooth the bumps that happen in normal business life. Slow payers, seasonal dips, unexpected expenses, and growth opportunities that require upfront cash. You need it when timing is your enemy, not when you want to fund long-term dreams with short-term money. Used well, it can reduce stress and help your business operate more confidently. Used poorly, it can become expensive, ongoing debt that quietly drags you down. The difference is mostly planning and discipline and being honest about why you're borrowing in the first place.